Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a past exam question from 2016 paper 2, then this is question number 4. In this question, we will first learn to identify the differences between capital and revenue expenditures, and then we will prepare the accumulated depreciation ledger account followed by the sale of non-current asset ledger account. I need you to focus and follow through the entire content because that way you will gain an excellent understanding. So I've really gone in depth on how we can handle similar questions in your main exam. So with that being said, let's begin. The accounting year of Jin Ye's business ends on 31st of October. So this is the time when the financial year of the business ends. During the year ended 31st of October 2016, the business bought a second-hand delivery van. The first requirement of this question is to go through each of these 4 items and identify which one of these items are capital expenditure and which one of these are revenue expenditure. So before we could do that, let's understand the differences between capital and revenue expenditures. Capital expenditure is when we buy or purchase a non-current asset or when we add value to an existing non-current asset. So on that basis, if we were to look at the first example here, purchase of a delivery van refers to purchase of a non-current asset for the purpose of usage within the business that will help the business generate more revenue. Therefore, this falls within the definition of a capital expenditure, where we are buying a non-current asset. The second example here is the special shelves, which we have fitted into the delivery van. So this is where we are adding value to the delivery van because by fitting the special shelves, we are actually improving our chances of making more revenue, all right? So therefore, both of these first examples fall within the category of a capital expenditure, and therefore we can take the capital expenditure for both of these first options. Now, what do we understand by revenue expenditure? Revenue expenditure refers to the day-to-day operational expenditure for the business. In other words, any money that you spend for expenses, for your regular expenses in running your business operations. Now, if you look into the third example here, annual insurance premium. So annual insurance premium basically refers to insurance expense, which is again part of the daily operational expenditure of the business. Therefore, this also falls within the category of a revenue expenditure. Again, when we are paying for insurance premium, we are not buying any non-current asset, nor are we adding value to an existing non-current asset. Therefore, we can confidently say that annual insurance premium is a revenue expenditure. Next, we have got the replacement of tire, which has been damaged during the year. So if you're replacing the tire, you're replacing it so that you can actually operate your delivery van. You're not really buying any non-current asset, nor are you adding any value to an existing non-current asset. You're simply replacing the tire, so it helps you run your business operations on a day-to-day basis, and therefore, this also falls within the category of a revenue expenditure. All right? So based on what we have done for the first part of this question, the first 2 items where we are buying a delivery van and also installing special shelves into the delivery van, both of these items are capital expenditure because we're buying a non-current asset and adding value to an existing non-current asset. The third and fourth option, which refers to purchase of insurance, that is mainly an expense. And the fourth option, which is the replacement of tires so that we can operate our delivery van and run our day-to-day operations, both of these options fall within the definition of revenue expenditure. Okay? Now, the main parts of this question. So we have done those questions in depth, so let's see what's going on. On 31st of October 2016, equipment which was bought on 10th of March 2014 for $12,800. So this is here referring to the original cost of this equipment, was sold and the business received a check of $4,500, which is what we refer to as the disposal proceeds. So simply speaking, on the 31st of October 2016, we have sold one equipment, and this equipment was bought on 10th of March 2014. And when we bought it on 10th of March 2014, we paid $12,800, which is the original cost. And then now that we are selling it on 31st of October 2016, we are selling it for $4,500, which is also referred to as the disposal proceeds. Equipment is depreciated at 25% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase and also the year of sale. Now, the requirement is to mainly prepare the accumulated depreciation account for the year ended 31st of October 2016. All right, so let's have your attention to the right-hand side where we have got all the workings. So we understand that we have sold a non-current asset, and that asset was bought on 10th of March 2014. So the first year of usage for this asset would be from 10th of March 2014 until the end of 31st of October 2014, because at 31st of October 2014, the financial year of the business would have ended, right? Now, based on the business policy, we are confident that we are applying a full depreciation in the year of purchase. So how do we apply a full depreciation? We simply take the given percentage and multiply it with the original cost. The given percentage in the question is 25%, and the original cost is $12,800, which gives us a full depreciation of $3,200. Now, I recommend you always calculate the net book value at the end of the financial year every time you're using the reducing balance method. So the net book value at the end of year 1, which is at end of 31st of October 2014, is calculated as the difference between the original cost and the accumulated depreciation. The accumulated depreciation stands for the total depreciation we have so far for the specific asset since the day of purchase. Since we are finding the net book value at the end of year 1, the only accumulated depreciation is a depreciation expense of $3,200, which we have derived for the first year. So the cost of $12,800 minus the accumulated depreciation of $3,200 gives us a net book value of $9,600 at 31st of October 2014. Now we're moving to year 2. So year 2 for this asset would have started on 1 November 2014, which is when the financial year of the business would have started, and end on 31st of October 2015. Obviously, that's when the financial year of the business would have ended, which is right after 12 months from 1 November 2014. So in this second year, if you want to find the depreciation using the reducing balance method, you take the given percentage and multiply it with the net book value, which you have derived at the end of year 1. So the given percentage is 25, and the net book value which we had calculated at the end of year 1 is $9,600. So 25% of $9,600 gives us $2,400 as the depreciation expense for year 2. Again, because we're using the reducing balance method, we want to find out the net book value at the end of the financial year. So we are finding the net book value at end of year 2 or at 31st of October 2015. How do we calculate it? We take the net book value which we had at end of year 1, which was $9,600, and then we subtract an additional depreciation expense of $2,400, which we have derived for year 2, and that gives us $7,200. Now, in this formula, we are also incorporating the original net book value equation of finding of the cost and the accumulated depreciation. Because since we already have the net book value from previous year of $9,600, all we have to do is now subtract an additional depreciation expense for the second year. So that way the accumulated depreciation gets taken care of, all right? So that gives us a net book value at 31 October 2015 of $7,200. Now we're moving to year 3. So in year 3, it would start on 1 November 2015 and end on 31st of October 2016, which is what we are mainly preparing this ledger account for. Because the question clearly mentions, prepare the accumulated depreciation account for the year ended 31st of October 2016. So we are mainly looking into transactions that have happened from 1st of November 2015 until the end of 31st of October 2016. Now, based on the business policy, we also apply a full depreciation in the year of sale, all right? And we would apply a full depreciation anyway because the asset was sold on the last day, which is 31st of October 2016. So the asset was in use for the entire 12 months. So the full depreciation here is calculated by simply taking the given percentage of 25 and then multiplying it with the net book value of $7,200, which we had at end of year 2. That gives us a full depreciation of $1,800 in year 3. And if you want to calculate the net book value at end of year 3, which is at end of 31st of October 2016, you simply take the net book value which you had got at end of year 2, which is $7,200, and then subtract the extra depreciation expense of $1,800, which is specific to year 3. That way, you get net book value at 31 October 2016 to be $5,400. Okay? Now, what's the total accumulated depreciation for this equipment since the day of purchase? So the accumulated depreciation for the 3 years of usage within the business is basically $3,200, which we have got from year 1, plus an additional $2,400 from year 2, followed by an additional $1,800, which we have just derived for year 3. So altogether, the accumulated depreciation for this equipment for the 3 years of usage is $7,400. Now, I need you to understand something. How should we record the journal entry for the depreciation expense for year 3 or for the year ended 31st of October 2016? Now, if you want to record the depreciation expense for the year ended 31st of October 2016, how do we do it? So we debit the expense account, which is the depreciation of equipment account, by $1,800, and we credit the accumulated depreciation of equipment account by $1,800. Because we have an increase in expense, all expenses, whenever they increase, are debited. So we are debiting depreciation of equipment, which is an expense account in itself, by $1,800. And then we credit the accumulated depreciation of equipment account by $1,800. So this $1,800 is specific to year 3, or basically the depreciation which we have derived for year 3 only, okay? Now, as you understand, accumulated depreciation of equipment is being credited here. And this is being credited because accumulated depreciation of equipment is a contra asset account. What do we understand by contra asset? Contra asset accounts record the reduction for a relevant non-current asset account, and the relevant non-current asset account in this case is the equipment account. So whatever depreciation the equipment will go through as it is being used within the business for the purpose of generating revenue, that depreciation, the total or aggregate or accumulated depreciation, is stored in a separate account, which is the accumulated depreciation account, and that is what we refer to as a contra asset account. By default, whenever contra asset accounts increase, we credit them. So that is why when accumulated depreciation increases, we are crediting it. So this journal entry to record the depreciation expense specific to year 3 for the year ended 31st of October 2016 is first to debit depreciation of equipment because expenses are going up in value, and when expenses increase in value, we debit them. And then we credit the accumulated depreciation of equipment account by $1,800 because accumulated depreciation is a contra asset account, which means when accumulated depreciation increases, we credit them, okay? Now, you will know why we need to understand this journal entry when we prepare the ledger accounts. Now, I also need you to understand one thing. So we know that we have sold this non-current asset, right? The equipment that we are doing all these workings for. So what's the journal entry to record the sale of non-current asset at 31 October 2016 when it comes to the accumulated depreciation we have recorded so far for this asset? So we understand, based on our discussion a while ago, that whenever accumulated depreciation increases, we credit it, right? But now that we are selling this asset, we no longer have the accumulated depreciation for the specific equipment in our books, right? So therefore, now we have to reduce the accumulated depreciation, which means now we have to debit it when we are selling this asset. So we debit the accumulated depreciation of equipment account by 7,400, okay? And the simultaneous credit entry is the sale of non-current asset account, all right? So when we are debiting accumulated depreciation account, we're obviously referring to the fact that this equipment is no longer in the books, and therefore the total accumulated depreciation is being removed, and when accumulated depreciation goes down, we debit it. And this is only happening because of the fact that we have sold this. So the corresponding credit entry is the sale of non-current asset account by $7,400. All right? And what is 7,400? So 7,400 is the total accumulated depreciation we've got so far for the 3 years of usage. We have to remove the entire 7,400 because we are selling this equipment, so we don't have anything in the books. So 7,400, as you know, was calculated for year 1, 2, and 3 combined. Okay? So just to be simply stating everything what's going on here, first we want to record the depreciation expense that is specific to year 3, which we do by debiting the depreciation account and crediting the accumulated depreciation account. Then we want to remove the accumulated depreciation for the equipment which we have sold. So if we want to remove the accumulated depreciation, we debit it and then we credit the sale of non-current asset. Now, how does all this play out within the ledger account? So let's have a look. So we understand that we are preparing the ledger account for accumulated depreciation for the year ended 31 October 2016. And here on the left-hand side, you can see that I have got the usual 5-column format, starting with the date, followed by the details, then we've got the debit, credit, and lastly the balance columns. So we are starting the year 1 November 2015 because, as we understand, the question clearly mentions for the year ended 31 October 2016. So we are starting at 1 November 2015 with an opening balance of $5,600 credit. So where did we get this from? So let me just scroll back up. So we know 1 November 2015 is the beginning of year 3. So prior to that, we had got 2 years, year 1 and 2. In year 1, we had got a depreciation of $3,200. And in year 2, we had got a depreciation of $2,400. So that means the accumulated depreciation at 1 November 2015, at the beginning of year 3, is basically the totals of year 1 and year 2. In year 1, we had 3,200. In year 2, we had 2,400, which is 5,600. Okay? So this is the amount that we are starting our financial year at 1 November 2015 with. So you can see the opening balance brought down, 5,600 credit. Then what happened during the end of the year? So at 31st of October 2016, all right, the first entry is to record the depreciation of equipment which is specific to year 3. So based on this journal entry which we have done here, you can see the accumulated depreciation of account is credited by $1,800, mainly because we've got an expense for year 3, which is $1,800. So as you can see, the accumulated depreciation of equipment account is being credited, which means this ledger account for accumulated depreciation at 31 October 2016 will show $1,800 in the credit side, obviously because we've got a depreciation of equipment, which is what you write in the details column as the relevant cross-reference. So I've written DEPN of equip in short, but make sure in exam to write the full form, which is depreciation of equipment. So this $1,800 of credit gets added to the previous 5,600 credit, which gives us 7,400 credit as the net balance at the end of this transaction. Okay? Next, we want to record the fact that we have sold this non-current asset and we no longer have the accumulated depreciation for the specific equipment in our books. So as you can see, based on this journal entry, we debited the accumulated depreciation account, obviously because we no longer have it, so we have to debit it. Because when we debit accumulated depreciation, we are referring to the fact that it's going down in value. And we are debiting it simply because we have sold it, right? So that is why within the accumulated depreciation ledger account, you will see that 7,400, which is the aggregate depreciation for 3 years of usage, is included in the debit column, with the relevant cross-reference in the details column being the sale of non-current asset. Okay? So 7,400 debited here gets offset against 7,400 credit, which leaves us ultimately with a net balance of 0. Okay? All right. So I'll just let that sink in for a moment so you can see what's going on. So when you're ready, we will now prepare the sale of non-current asset account for the year ended 31 October 2016. All right. Now the sale of non-current asset account is done in multiple steps, but I need you to first understand the journal entries that could explain how the ledger account is constructed. First of all, when you're preparing the sale of non-current asset account, you want to remove the original cost of the asset which you have sold. So the equipment had an original cost of $12,800, right? As you can see here, I'm placing a tick on the left-hand side. So equipment in itself is an asset account. Now that we have sold it, this asset no longer remains in the books. We know that when assets increase, we debit it. Now that we have sold it, and the fact that this asset is no longer in the books, we have to reduce this asset, right? And when we reduce assets, we credit them. So we're crediting the equipment account by $12,800, all right? And the corresponding debit entry is obviously the sale of non-current asset account by $12,800, all right? Next, we want to remove the accumulated depreciation for this asset, which you have already looked into the previous section. So we understand accumulated depreciation, when it increases, we always credit it because it's a contra asset account. Now that we have sold this equipment, this asset no longer remains in the books, and we have to remove the total accumulated depreciation for this asset. The total accumulated depreciation for this asset for year 1, 2, and 3 is $7,400. So when we are removing it, we do debit accumulated depreciation of equipment by $7,400, and obviously credit sale of non-current asset as the corresponding entry by $7,400. Next, we want to find out any gain or loss we have made on the sale of this non-current asset. So the cost of this asset was $12,800, and the accumulated depreciation for year 1, 2, and 3 is $7,400, right? How do we find the net book value at any given point in time? We just simply take the difference between the cost and the accumulated depreciation. So we subtract $7,400 from $12,800, which gives us $5,400 as the net book value. The net book value refers to the economic benefits or the value that is still available for consumption within this non-current asset, all right? We ended up selling this asset for $4,500, which is what we refer to as the disposal proceeds. So as you can see, the asset had a value of $5,400, but we ended up selling it for $4,500, which means we ended up selling it for less than what it was actually worth at this point in time. This means that we've made a loss, which is simply the difference between the net book value of $5,400 and the disposal proceeds of $4,500, which means we've made a loss of $900 on this sale. So what's the journal entry to record this loss? All losses are an expense, right? And expenses by default are always debited when they increase. Therefore, you would be debiting loss on sale of non-current asset by $900, with the corresponding credit entry obviously being sale of non-current asset because that's what we're working with, and the amount here is $900. Last, you have to record the disposal proceeds, which is the amount that you get by selling the specific asset. The question clearly mentions that the business received a check of $4,500, which means we are receiving $4,500 in our bank account. So bank account is an asset account, and when assets increase in value, we debit them. So that is why we are debiting the cash at bank account by $4,500, and obviously the corresponding credit entry has to be the sale of non-current asset account by $4,500. Now, how should we present all this in the ledger account for sale of non-current asset for the year ended 31st of October 2016? Now, we know the sale took place on 31st of October 2016. So obviously there can't be any events prior to 31st of October 2016 relevant to this sale. So at 31st of October 2016, we will first start by removing the original cost. So based on our journal entry, we know that the sale of non-current asset account is to be debited by $12,800. So that is why we are debiting $12,800 at 31st of October 2016, and the relevant cross-reference in the details column is the equipment at cost. All right, so that's why the net balance at the end of this first transaction is 12,800 debits, because we don't obviously have any credits yet. Next, we're removing the accumulated depreciation. So you can see the sale of non-current asset account is credited here by 7,400. So you will see that in the ledger account, we're including 7,400 on the credit side, with the relevant cross-reference in the details column being the accumulated depreciation of equipment account. Again, you can see I've written in short, but make sure to write the full form in the exam. So now you've got 7,400 credits, which are subtracted from 12,800 debits, and we are left with 5,400 debits, because obviously debits are higher than credits at the moment. Next, we want to record the disposal proceeds, which is the amount we have received by selling this asset. We know that we have sold this asset for a check of $4,500, which is increasing our bank balance. So we are crediting the sale of non-current asset by $4,500, right? So therefore, $4,500 is here recorded on the credit side, with the relevant cross-reference obviously being the cash at bank account that's included in the details column. So 4,500 credit now gets subtracted from 5,400 debit, which leaves us with $900 debit. Lastly, we will record the loss which we have made. So you can see this, all losses as we have discussed are an expense, which by default is debited, but the sale of non-current asset account in itself is credited. So therefore, the $900 is to be recorded on the credit side, with the relevant cross-reference in the details column being the loss and sale of non-current asset account. And as you can see, the 900 credits here can simply offset the entire 900 debits that we had at the end of previous transaction, and we should ultimately be left with a zero balance, which should always be the case whenever you're preparing a sale of non-current asset ledger account, because if you don't have a zero balance at the end, something is wrong, okay? You have to make sure you're always ending with a net balance of zero whenever you're preparing the sale of non-current asset ledger account. Yep, so that's it. So I'll just let that sink in for a moment. So as you can see, if we go through the journal entries, we know how everything actually adds up logically. So the journal entries are prerequisite to preparing the ledger accounts. You don't obviously have to do the journal entries during the exam. Maybe you might be asked to do it, but if you know how things actually work together, then it makes learning fun, all right? Okay, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And in the description, you'll find a link to book a free Zoom call with me and discuss your coaching requirements so that I can help you prepare for your exams in October. With that being said, I'll conclude today's lesson, and I'll see you in the next one.